Why is everything crashing? Why is this turning out to be the everything sell-off that is burning traders? It has to do mainly with interest rates and more to do with long-term interest rates. The yield curve is inverted, which means you get more for short-term trades, a higher interest rate for short-term bonds than for long-term bonds. But it's starting to uninvert, but it's uninverting in the way we did not expect. We expected that short-term rates would come down. That's not happening. Short-term rates keep going up. The 2-year bond is like at 4.9%, but the yields on long-term bonds is starting to go up. And so I think it's going to uninvert by the long-term bond yields going up. The 30-year bond yield went as high as 4.3%, which is massively higher than it's been before. And the 10-year yield, which is very significant, at one point hit 4.18%. Now it's settled down a little bit to 4.06%, the 10-year bond, but that's still high. When you're over 4%, that is very significant. And it leads to less purchase of houses. And I think the Fed may be doing this by offloading, selling their assets that they've gathered. When they sell off their balance sheet, that tends to raise interest rates, especially on the long-term side. And so they're fighting inflation by having housing prices come down, which I think is going to be the long-term effect. The Fitch credit rating agency downgraded U.S. debt from AAA to AA+. And the effect of that will be to increase our interest rates. So we've got all these factors going against us that are going to increase the interest rates on long-term interest rates, and that's going to affect especially purchases of houses and cars, but it does fight inflation. Early in the week, Qualcomm, whose symbol is QCOM, reported that their sales were down. Okay, and this is important because Qualcomm is the largest maker of cell phone processors that there is. And this should have foreshadowed to us that Apple was probably going to sell less cell phones later in the week when they reported earnings, which on Thursday they reported that their cell phones were down in sales. And after Apple announced that, they went down 4.8%. Now, Apple is a $3 trillion company. So in one swoop, its market capitalization went down about 140 billion. So you can see why that took the whole stock market down. And Amazon did amazingly well, and they reported good earnings, but even they went down later in the day on Friday. And I think it mainly was in sympathy with Apple coming down because Apple is so huge. And there's YouTube traders that made a lot of money by shorting Amazon at its height. I think at its height, it was like at 144, and it came down to 140 or less. And so they made good money shorting it. Part of the reason Fitch downgraded the U.S. credit rating was because of the extreme political divisiveness they see in the country and how we have a lot of trouble raising the debt limit without being a show and threatening a default, which worries investors around the world that buy U.S. debt. So this is something with our unusual politics right now and the candidates we have running for president. This is not a good situation. It would be much more helpful if we had some moderation from both sides. Other negative factors include the Saudis and the Russians uh, extending cuts on oil production, which could raise the price of oil and which could contribute to more inflation. The VIX, the volatility has increased on the stock market. And when the VIX increases, there's more danger of having sudden downfalls. And the VIX, it had gotten very low. It was when the market was really rallying and charging forward, it was in the 13s, and now it's at 17, which is still very low, okay, and favors a continued rally. But it's the fact that it went from 13 to 17 in about 2 or 3 days that makes it worrisome. On Friday, the stock market was a real roller coaster, charging up the roller coaster as we got good job numbers, in the sense that we had 187,000 jobs added, and the Fed was looking for it to be less than 200,000, and they wanted to come down somewhat without coming down too much, and coming down to 187,000 was about perfect. So the market charged up. But then the Apple earnings was weighing on the market because of the decreased cell phone sales, and the market just petered out and just blew it in the later stages. And for this market right now, the way it's standing, last week was the first negative week in many weeks, okay? And right now, the way the charts are working out, it looks like you're ahead to short the rallies, that you're ahead to fade the rip, as they call it, than to buy the dip. So on Friday, we had a real roller coaster as the market charged up 1% on the jobs numbers, and then completely fell out and went down about 0.5% by the end of the day. And Larry Summers, he put more negativity on the jobs numbers, because even though the jobs added were somewhat less, he talked about the wage price increases. Wages increased at a level that he thought was of concern. And also he thought that the United States needed to start being worried about how much debt we are accumulating. We have like $32 trillion of debt, which is massive.
At the end of the week, we got the jobs numbers, and they were a little light on the number of jobs, 187,000 as opposed to 200,000. A little heavy, actually, on the wage increases. What do you make of them?
Look, nobody should change their minds fundamentally on the basis of these numbers. They were pretty close to expectations. As you said, economy was softer and inflation was a bit stronger than expected, so that's not terrific. But again, not a big deal from these numbers. Look, I think the big story here all along is we're trying to land the plane on the runway, where we're worried that the plane would crash short of the runway. That certainly does not look like it's going to happen. We've got a very strong economy, and we're worried that the plane will overshoot the runway. If you look at wage inflation, it was faster for the month than for the quarter, faster for the quarter than for the year, and running for the quarter at about 4.9%. That's not consistent with 2% underlying inflation or close. And unemployment ticked down, vacancies ticked up. We still have a tight labor market, a very tight labor market. And with 187,000 jobs created and population growing 50 to 100,000 a month, we have not just a tight labor market, but a tightening labor market.
The last major factor is seasonality of the stock market. The stock market in my lifetime has loved to go down. The big crashes have usually occurred around September and October. And that tends to be followed, if we're lucky, by a holiday uptick, and it tends to go up during Christmas. And so I'm tentatively planning to mostly stay in cash, because that is the safest thing. You're getting 5% return, which you haven't been able to get for like 15 years. And it seems kind of foolish not to take advantage of it, especially when things are as uncertain as they are. But I think if we get a downturn, we could think about investing and hope for the holiday improvement. And a lot of this will depend on the inflation numbers that come out. And we have a major CPI coming out on August 10th, and there's going to be some wild swinging of the market around August 10th. But I think another major event with the stock market will be NVIDIA. That is the last major earnings to report of the second quarter. NVIDIA reports earnings on August 23rd. And so if NVIDIA reports 11 billion or more of earnings for the second quarter, that's going to send things running very much higher. And Jeremy Grantham has predicted that artificial intelligence could keep the rally going for another 3 or 4 months in spite of the negativity. So I think it's going to turn at some point, but I think the turning might not be dramatic. It'll hopefully come with the Fed deciding to stop raising rates, which they have decided. There's less than a 15% chance that they're going to raise rates a quarter of a point. They're just going to keep them the same. And they're not going to do that until September 20th. So we're sort of safe from rate increases until the 20th of September. But I think things could work out well, but it all depends on inflation. And that's why this August 10th number coming up is so vital. Thanks for listening and watching. Be sure to like and subscribe if you haven't already done that, and I'll keep bringing you the news that's relevant to my investing. Thank you.
My heart rages around like an ocean.